Bismillahirrahmanirrahim. This is the almost the last portion of your money and banking class, and in this we will be discussing about business finance. So far, the first portion or the first section of your course outline was related to money and its function, and then banking, commercial banking, central banking, and after that we have discussed certain details about Islamic banking, certain modes of Islamic banking. Now we will be heading towards a finance, that is actually business finance. You have already discussed this business finance into your business finance major course, and after that you will be have discussed many other aspects in financial management. I will be giving you a little overview of business finance, like what is business finance, what is its uses, and what you will be using this in your businesses. So first of all, when we talk about business finance, it actually relates to the amount of money that is called as capital and credit employed in the business. When we talk about money, or we talk about investment, so there the total capital which is invested in the business is actually composed of majorly two components. One component is your the amount of money which is actually being generated by the company, plus the amount of money which is come from your savings and savings or from your own sources. The other portion is actually related to your credit. That means the amount of borrowed money. That amount of borrowed money might be from in issuance of bond, that might be from borrowing loan from the bank, or it might be for long term or for short term. And another aspect is your trade credit, like when you get credit from your suppliers. So there are number of credit sources, and the number of equity sources, both are actually being discussed in business finance. It deals with those activities which have to do with the possession or provision of funds and management of funds. That means that business finance will help you and will guide you that how you will get finance from different sources. Like one way we have discussed in business finance that that in order to generate funds for your short-term needs, you will be going in a money market where there are lots of financial instrument available, there are call loans, there are commercial papers, and many other instruments are available which will help you to generate funds. And management of these funds, that how you will be going to manage these funds, which is actually related to management of your all your asset within your business, because all your asset has been acquired from funds. So it is actually related to provision and management of funds. When we see the actual definition of business finance, we can say that it can be defined as that business activity which is concerned with the acquisition, as I've discussed, that how you will going to acquire funds, whether it is your IPOs, like in initial public offerings, where you are increasing your the stocks, shares, or whether it would be a issuance of your bonds, long-term bonds, short-term bonds, or whether you will be going to acquire funds from your other sources like your banks or other financial institutions, or whether you will be going for trade credit, or whether you will be generating profits and you are investing that amount in you reinvesting that amount in your business. And conservation of funds in meeting conservation of funds actually associated with the proper utilization and safety of funds. You have to make your internal control such like that there would be no theft, there would be no misutilization of these funds. Plus you can be using these funds with an optimal benefit, that you will be using this to meet the financial needs and overall objective of the business enterprise. As business is there for generation of profit, as business is there with many other objectives, increasing their revenues or introducing their products world over, or at least within the country. So there are number of objectives of the enterprise. So all these things which be all these funds, acquisition of funds and conservation of funds, actually they are intended towards a generation of maximum amount of profit, and overall achieving the objective of the business for which that enterprise has come into existence. Now, if we look into the kinds of finances like fixed capital and long-term capital, actually, when fixed capital and long-term capital is a capital which is invested in the business for a longer time period. And if you want to take out this capital, you have to wrap up your business. And because these are the physical asset you require for the existence of the business. And like for example, you need land for for a business, you need a building for a business, you need a machinery, equipment. So all these things are actually very much important for the existence of the business, and this is called as fixed or long-term capital. And this capital is actually required over the life of the business, and from time to time you can increase or decrease, or you can replenish, or you can go for a maintenance for these assets, or these things which you are in are actually being taken from this fixed as a fixed capital. But this capital is required over the longer run. But as compared to fixed capital, we have another type of capital which is called as circulating capital or a working capital, and it can also be called as operating capital because it is required for the business, and the company is continuously replenishing this capital, where there are times when there are very lower level of this capital, and after that this capital is replenished. So in this kind of capital, as you have already discussed in accounting, that we have a cash, we have account receivable, we have marketable securities, we have inventories, we have different kind of prepaid expenses. So all these things are actually important for the company because these are working for the generation of profit. So that's why it is called as operating capital, because this capital is continuously on work and it is circulating. Like the inventory is converted into cost of goods sold, and cost of this goods sold is converted into account receivable or into cash. And after that, again, when you have cash or cash, so obviously you're going to you go and buy for inventories and so on. This process goes on and on. So this kind of capital is obviously required, but from time to time, and it is very important for the operations of the business. So there are many factors which can affect the needs for working capital. Like when we talk about types of working capital, so there are revolving working capital and permanent and regular working capital. So when we talk about revolving working capital, so revolving working capital is that capital which actually continuously going on. Like for example, when inventory is converted into cash, and cash is converted into inventory, and so on, there are account receivable involved. So continuously this capital is going on and on, and there are certain times that like when there is seasons, or there are and many other factors, so you can increase or decrease this revolving capital. But as compared to this working capital, there is permanent and regular working capital. This type of working capital is required for because you have to go on. Like for example, you need salaries for your employees, and these are permanent needs, because you have to give employees monthly salaries to your employees, or you have to pay rent of the of your or rent of the of your different buildings, or any other things which you have borrowed on rent, or many other things. So permanent and regular working capital is there. These are short-term needs, but they are regular needs, and you need this minimum amount of capital for the business. And there are many factors which can affect the needs for working capital, like nature of the business, because there are many type of businesses which are related to service sector. Like for example, lawyers, or the companies who are providing legal services, the company who are providing financial services. So in that case, or doctors and so on. So depending upon the nature of the business, like in a service sector, the working capital needs are less as when we compare it with the manufacturing company, because there are a lot of raw materials involved, and many other requirements are involved. The factors which can affect working capital needs is the main, or can say the important factor, is the nature of the business. So the nature of the business, after that size of the business, like it's a common sense when you have a larger setup and you are dealing in different countries, or you are working in different, even you are working in different cities of the country, or in the same country, same city, you are dealing in different products, different markets. So in that case, obviously you require more working capital as when if your operation scale is on a smaller one. So size of the business is another factor which can affect the needs for your working capital. Then another thing, which the length period of manufactures. There are many type of products which can be converted into finished form for in a very smaller time period, or in a very it does not require a longer length, or a longer period for conversion, like FMCG goods, that fast moving consumer goods, like your Pepsi, Coke, and many other things. But there are certain products which needs more time period for conversion, like if you are making, or your company is making is making a Boeing or a bus, or is this kind. So those products which need a smaller time period, or a which can be conversion needs lesser time period for conversion. In that case, there are working capital needs are a little lower as compared to the product which need longer time period for a manufacture. So because in FMCG goods, or in that case, the product can be converted into finished form, and then they'll be converted into cash, and that cash can be used for buying raw material for that. So the operating cycle is very small, so you can use that cash for continuous operation. But in case of the products which need more time for manufacture, in that case, operating cycle is a lengthy one. So you have to continuously put working capital, or components in that kind of products. So in this case, they need a longer time period for manufacture, so you need more working capital as compared to FMCG goods. So this is another factor which can affect the needs of working capital. Now, other factors are method of purchase and sale of commodities. Like there are different type of businesses. In this case, actually, they are talking about credit and cash-based systems. Like there are three different ways. First of all, when the company supplier can provide them products or raw material on credit. So in the end, the company is giving their customer, and they're selling their products on credit. So in that case, there are fewer needs of working capital, because in both cases, they can be facilitated by credit. Another thing is when supplier are giving them on credit, raw material on credit, and they do not provide their customer on credit. In that case, obviously, they are supported by supplier, and working capital needs are fewer. But the problem arises when supplier is not providing you raw material and supplies on credit, and you have to give your customer, or you are required to sell the products on credit. So in that case, there is a problems for the company, and they need more working capital, or they need more short-term finances in order to finance its raw material. So the method of purchase and sale of commodity is very much important, and it is an important determinant or factor which can affect the needs for working capital. Then we're converting working capital asset into cash. So it's also very much important that this is actually associated with the efficiency of the company, that how they are converting their inventory into cash, whether they are capable enough, and whether their operations are swift enough to convert their working capital into cash as easily as possible. And secondly, there is another thing which is very much important, is collection of your account receivable, that is associated with your credit policy. So the inventory, conversion of inventory, and a collection of your account receivable is actually yeah, determine the needs of your working capital. Because if you are not properly making conversion, or you are not efficiently using your inventory, so obviously your cash would not be there, and you will not be getting cash, because your products are actually not in a finished form as quickly as possible. So in that cash, the cash, you need finances, because your conversion cycle is delaying. And another thing which is actually important is your credit policy. If you are not devising an efficient credit policy, it creates problem for you, because the people are not giving you money as quickly as possible, and you have to go for short-term financing, because obviously you don't want to hinder your operation cycle. So obvious conversion of working capital into cash is also an important determinant for your working capital needs. Then another important determinant is your seasonal variation in the business. Like there are many businesses which are of seasonal nature. Like for example, if you have a coffee cafe, or if you are dealing in your software or beverages industry, or many other things are there. So in when you are actually heading towards season, so you immediately before the seasons start, you need funds. In European countries, the Christmas period and the Thanksgiving period is actually very important season, and in this period people will go and buy products, and there is a lot of selling and purchasing in there. So in that case, you need more funds in the before the season starts. So in this case the people need more funds, and the company have to arrange for working capital in this case. Then risk in the business, riskier business are actually are in more needs of working capital as compared to the business which has less risk. Then size of the labor force. If you have a larger labor force, you have more employees in your business, and more people in your business, and at different managerial levels. So obviously you have to pay to them, and these are short-term needs of the business, because or short-term expenses of the business. So in this case you need more working capital. Then price level changes, and nowadays this phenomena is very much popular, but because our major raw material and many other products are associated with the prices of petrol and many other factors. So when petrol prices rises, or many other fuel adjustment charges and electricity prices increases, there is immediate increase in the prices of different goods, and so is the case with the prices of different raw material. So obviously when there is an anticipation that in the future the prices will increase, so people will stock up their raw material in order to avoid their cost, or in order to avoid increase in their cost. So in that case they need more funds to stock up raw material for them. So obviously they need more funds. Then state of the business activity, this is actually associated with the trade cycle, as we already discussed that the business activity goes through a different cycle, like from a growth level to they'll go for the boom phase, and from boom phase the recession phase, and from recession phase the depression, and again go to growth phase. So when we talk about in the growth phase, so growth phase is a period when the investor is very optimistic, and they are continuously investing in different type of business. So obviously the production is actually increasing, and they are going to increase their production, and which has actually impact on the needs for working capital. So in that in boom phase and in growth phase, working capital needs are high, and people are investing more in their businesses. So this is the period when people are more actually in needs of working capital. But when the recession phase is there, so obviously the people are anticipating that the future profit will decline, so obviously they will curtail their production and their needs for working capital decreases. And in depression phase, there is actually it's actually a deadlock of your business activity, so obviously there is no need of working capital, and of very few minor or very low level of needs for the companies who actually are going to sustain the depression phase. Then rate of turnover means the amount of sales of the company. If your turnover is high, so, you will be in a position to finance your different activity, and there is low needs of working capital. And vice versa, when there is low turnover, in that case you need more funds because you are not financed by your sales. Then business policy is actually associated with the company who and their strategies and what type of policy they are going to pursue. In certain cases they want to have a large amount of or high levels of inventory, so in this case they need more funds because they want to pile up their inventory. Or in another case, there are companies who are very efficient in their management, like we have discussed in the case of Japan, who have shortages of warehouses. So they have arranged a system that is called as just-in-time inventory, and they have arranged their operations in such a way that whenever their inventory finishes, the new batch arrives at their door. So this is their business policy. So the needs of working capital is also associated with what type of business policy is pursued by the business. As we have discussed different factors associated with the needs of working capital, we also have to discuss types of business finance, as these are the finances which are available in money market, in capital markets, for the facilitation of your business environment or business sector, and they'll provide loan for different purposes. So mainly when we talk about the business finance, also there are three type of business finance. One is short-term finance, and mostly these finance are available in the money market, and they are actually debt instruments, and they will provide a loan for a shorter time period that actually is for maximum 1 year. And second is your medium term finance, which is actually the time duration for medium term finance is from 1 year, more than 1 year, to 5 to 7 years. Then we have long term finance, which is actually more than 7 years up to 30 years. So these are different types of finance which can be provided or which can be available in the financial market for the facilitation of your business. Now, as we have discussed that there are different sources of funds for the companies, and when the company needs funds, they have to see that how they can finance different operations. Like certain time, the company want to expand their production, so they need they need money in order to finance this activity. So there are different sources for a company in order to finance their different activities. One is owner's capital. That means that the owners can give you the money, which is more beneficial source. You are not liable for any interest or any other thing. So issuance of equity shares. If you are a corporation business, so you can issue shares and generate funds through IPOs. Secondly, blowing back of profit. That is when company is in operation, they generate profit, and according to the dividend payout policy, you will see that how much funds should be distributed among shareholders and how much funds should be reinvested in the business. That is called as retained earning. So that is actually flowing back of profit. The amount of profit which is being reinvested in the business is called as your retained earning, and this is another sources of finance for the company. Then another major source of capital is your debt sources. Debt means that you will be getting loan, or you'll be borrowing money from some people, and you, as you are borrowing that money, you have to pay certain interest. So first is your debentures. Debentures are kind of these are actually bonds, unsecured bonds, which are issued by the companies, and these this actually depends upon the credibility of the company, and how, and their default risk, and the companies who have low default risk, they can acquire funds on lower interest rate as compared to the company who have higher default risk. And what is default risk? Default risk is actually associated with the company's previous record of paying back to its debenture holders the amount of interest, and the amount and after the due date, the amount the amount which has been borrowed. Depending upon the default risk, the company has to pay interest on their loans. Then bank loans, these are being provided by different banks, and after that we have loan from DFIs, that development financial institutions. There are many development financial institutions which are specialized in certain sectors, like there are SMEs bank, there are bank which will provide so finances to industrial sector, microfinance loan, or agricultural loan. So these actually loans are there for specialized purpose, in order to boost that sector. So this is another source of finances to the company. Now, when we talk about merits and demerits of equity and debt, because there are certain advantages and disadvantages associated of both type of financial sources. It might be equity, it might be debt, but there are many advantages and disadvantages associated with both type of finances. First of all, we will be discussing merits of equity. Like, first of all, it's a permanent source of capital. When you are borrowing money your shareholders, so it is actually a permanent source of capital. You don't have to pay it back. You are not liable to pay a dividend if there is no profit. If there is profit, so you can pay them dividend, and in certain time you are not in a position to pay them dividend, so you don't have to have any penalty. You can pay the dividend whenever you generate profit. According to dividend payout policy, you can pay them dividend. So it is a merit. Then obviously this is a equity finance, so there is no worries of payment of interest. In case of debt, the creditor is not interested in your condition of the business. They are only interested in getting the interest on time, and if you are not able to pay them interest, this interest will accrue, and the burden of loan will become increased, and you have which will actually give you different type of financial worries. Then improve ability to meet business recession. In business recession period, the company is anticipating the decline in their their sales, and when the equity finance in case of equity financing, they'll get a reasonable amount of money, which will help you to survive in the period of business recession. Then financial worries of freedom from financial worries of borrowing. When you are borrowing funds from debt market, and in that case, obviously, if you are borrowing money from banks, or borrowing money from DFIs, or borrowing money from your from financial market, like issuing bonds, so in that case, obviously, in case of bank loans, you have to put a security for them, and if you are not able to pay them that amount, you will be getting you lose your asset. So, and you have to pay interest on time, and you have to pay back the amount you have borrowed on time. So there are a lot of financial worries associated with borrowing, but this kind of financial worries are not there for equity financing. Then earning remains with the bank in a form of retained earning. There are certain amount of money, like according to your dividend payout policy, you will not pay 100% of profit to in the form of dividend. You can pay a certain amount of money, or amount of profit to your shareholders, and the remaining amount is reinvested in the business. So obviously there are certain amount of earning which remain with the bank. Then there are liquidity of asset. In case of borrowing, you have to pledge, or you have to mortgage a certain amount of assets with the banks or DFIs. In that case, your asset is actually less liquid, because you cannot get finance on those assets which is already mortgaged or which is already pledged. And if you are using equity finance, so in that case, your assets are free from any kind of pledging, and in the future you have an opportunity to use that asset for any other you can asset for mortgaging them, or the source is open. Or if you want to sell that asset, there is no worries for you. You can sell that asset and arrange the amount of funds you need at that time. Then obviously the same is case with the ability to borrow, because if you are using equity and purely equity, the borrowing option is open for you, and that source is available at your disposal. So this is another important merit of equity finance. But there are certain demerit associated with equity financing. First one is idle cash balances. You are because when you are purely using equity finance, so you have to put certain amount of money, because you need that money in the future, and you might think that this money can be used, or this spend required for purchasing of raw material, or payment of any expenses in the future. In that case, you will be putting more amount of cash balances, and in business scenario, we always say that don't put your idle cash, let your cash work for you. So invest it in certain amount of marketable securities, or in money market, so that it can earn certain amount of money. But in this case, if you are purely using equity financing, there are a lot of amount is present which is idle, and it is not working for itself and not earning. Then over capitalization, you can generate more funds through equity market, and you can invest more than what is required. That is called as overcapitalization, which is another problem. Then weak control, because if you increase more and more of shareholders, so obviously they'll get voting rights regarding many other issues. So your control would be in decrease, because you are increasing more owners. Then another thing is no advantages of borrowed capital. There are certain advantages of borrowed capital, because when you are declaring your profit, before that you have to deduct the interest, and when your interest is deducted, your profit will decrease, and you have to pay low taxes, and this is a major advantage of debt financing. Another thing is your it can also it can be helpful in your expansion at any cost. So there would be because when you are borrowing money, so you can make more expansion and use that for the expansion of the business. But this kind of thing is not being this advantage could not be availed in equity financing. Now we will discuss merits and demerits of debt financing. Financing is actually your borrowed money, borrowed fund. There are many advantages of borrowed funds. First of all, expansion of the business. Um, expansion. There are certain time, like when you are going through an expansion phase, and you are anticipating that you will be getting the profit would increase, and there is a lot of prospectus in the prospects, and your business will grow in the future. So in that case, or there are customers are increasing, or you are in a position to get more profits. So in that case, you want funds for the expansion of business, and you are seeing opportunities. So in this scenario, debt financing would more helpful, because you will get funds and you will be easily in a position to expand your business and generate a profit. Another thing is, when as you are using debt financing, and creditors are not associated with your with what you are doing in the business, they are only concerned with getting interest, getting back the total amount they have given to you. So they don't say anything in the business. They do not have any say in the business, as compared to your equity financing. When you are going to or you are using equity funds, in that case you will be increasing your owners, and they have equal rights on the amount of assets you have, and they can give their opinion in the business, and they get the more voting rights, and they can give their suggestions in the journal meeting, and selection of board of directors and all those. But in case of debt financing, creditors have no say in the business. And one is your profit. You'll be getting profit, and you will be increasing your business, expanding your business, and getting your profit. So it can helpful in generating and increasing the amount of profit. Then another thing is your tax advantage, as we have already discussed in equity financing, that when you declare your profit, you have to deduct your interest expense before that, because when you declare your net profit, the taxes are charged on that thing. So we can say that interest charge on your loan is tax deductible item. It will increase the it will help it would be helpful in decreasing the amount of taxes paying to the government. So another advantage of using debt financing is its tax advantage. Another thing is your urgent current expenses. There are good times in the business, there are bad time in the business. There are certain time when company is in urgent need of expenses, like they have to pay their electricity bill, or they have to pay funds to their employees, or they have to salaries to their employees, or wages to their labor. So in that case, you need an urgent current expenses, and you have to current you need urgent money in order to pay current expenses. So this in this case, this debt financing would be more helpful, because they will facilitate you in this regard. If you remember, we have discussed different type of money market instrument, like call loans, and like repos, commercial papers. So all these short-term finances or short-term financial instrument can be helpful in meeting the expenses of the company for a short time period. So then after that, saving the business from dissolution. There are certain time the company is in a position to close down its business activity, but the debt financing through debt financing, in this case, they can pledge their fixed asset and get a large amount of money, and use that money for making the company more stable, and continue their operations, and buying and paying back to their suppliers, and save your company from dissolution. So in this case, this debt financing would be helpful for the business. But as there are many merit associated with debt financing, there are different demerit of debt financing. first demerit is payment of interest. The the correct creditor are only interested in getting the interest and getting back the amount of money they have borrowed to you, and they are not very concerned about your condition of the business, whether you are generating profit or you have. There are times when you are not, the market is not paying you back and the customers are decreasing, or you are losing your market share. They are not interested in that. They are interested that you should pay the amount of interest on time, or any other arrangement in which you have to pay principal and interest both. So they need their installment on time. uh, but they are not concerned with your condition of the business. Another thing is creditor can sue the business. If the company is unable to pay back their loan, the company has a right, the creditor has a right to sue the company, sue the business, and recover the amount by selling the pledged assets, and so on. And in the case of losses, they are not concerned with that. They only concerned with the getting the amount of interest. They are not much concerned about your losses. Then another thing is dissatisfaction among shareholders. This is something very much important, because when you are getting more and more of your on loan, so it create a dissatisfaction among your shareholders, and they think that the company is the company is getting too much loan, which will obviously have pay more, or which are not very good for the asset of the business, because their claims are on all the assets of the business. And if the company are pledging those assets or mortgaging those assets, and getting loan, so that means that they are not in a position to finance their operation through profit or through equity, because the company is not in a good condition. So the shareholder become dissatisfied. So this is another disadvantages associated with your debt financing.